And it's an astonishing windfall for Donald Trump. His fortune just skyrocketed as Truth Social stock takes off.
Shares are soaring.
This is pretty extraordinary.
Shares in Truth Social started trading Tuesday under Trump's initials DJT. And they're selling like hotcakes. Investment experts are stunned.
DJT, it is exploding on the scene right now. So this stock is really defying the logic.
Trump owns 58% of the company, potentially worth up to $5 billion, quadrupling his wealth overnight. But not so fast.
I saw you sent a note out the other day to everybody trying to explain the valuation of this Trump company. So put that aside for 1 second, because that's interesting in and of itself. Trump's got more money out of this thing than logically it would be worth. But there's something else to it.
I frequently ponder the age-old questions like, why do bad things happen to good people? And why do good things ever happen to Donald Trump? Yesterday, the Trump Media and Technology Group owns Truth Social, completed a deal to go public. According to Bloomberg News, that deal increased Trump's net worth by more than $4 billion, making him one of the world's 500 richest people. He made over $4 billion misspelling things on the toilet.
We're seeing it in SPACs. We're seeing it in IPOs. We're seeing it in last day dated options. There is a lot of speculation out there. And let's face it, I don't know the exact number, but roughly half the country is supporting Donald Trump. And he's got some financial difficulties. And I think there's a lot of people out there that just say, I'm going to buy the stock just to help the Donald. And they're doing it. Now, would I touch the stock personally? No.
Coming up today, stock stage reversal, a toothbrush powered by AI, media meltdown as Trump's stock soars again, solar stocks rip higher, along with shares in cannabis companies, and a look at Bill Ackman's hedge fund returns. So after having that 3-day pullback, we actually bounced up a bit here today, and it doesn't look like it, but the S&P 500 actually just put in an all-time record high closing price, and it's only a few points off an all-time high, and a bit of a bounce back. In most sectors, however, we've still got semiconductor stocks and momentum stocks underneath their 5-day MA. Stock market overall still holding this tight uptrending channel. Still a little bit of softness in the Magnificent 7 stocks. Standout today was a Russell 2000 small caps, up over 2%. And just looking on the monthly chart, looking really constructive there. Breaking out of this rounded base that's been developing over the last year and a half. Things are looking good for small caps. Volatility still down on its knees, now below 13. Still getting a little bit of a pullback in bond yields. There's Bitcoin just under $70,000 a coin. Gold sitting right at all-time highs, $2,200 an ounce. Oil still trading firm, just below $82 a barrel. Got the agricultural commodity fund walking the line higher here. Winning sector today was clean energy. Looks like we may have found a low here. Bounced up pretty hard, over 5% today, thanks to solar stocks putting in a really good rip. And the winning factor today was dividend shares, up 2.35%. Normally a low volatility sector. They too are looking constructive on the monthly chart, and looks like they may have broken out of this downward trend and prepared to move higher again. Doing even better than clean energy today was my number one pick I gave out at the start of this year. That's Cannabis shares. Looking at the ETF MSOS, which owns US cannabis producers and retailers. Now up over 50% year to date. And my regular viewers will remember, back down here on the 12th of March and 13th of March, I was saying it's likely we've found support. It was a good time to add, of which I did myself. And a few people have messaged me since then and saying, how did I know to buy down here? Well, it was simple. All my technical indicators were lining up. These green arrows here are my reversal signals. It's coming down near the bottom of the buy-sell band. My DSI was oversold. My trend strength was negative, showing the market was ranging, and my institutional buying percentage indicator went green as well, showing it was likely that big money was accumulating shares. And since that swing low, we are up a quick 39% and just coming up to these multi-month highs we haven't seen in quite some time. And looking at this volume, on top of some momentum thrusting signals we got a bit over a week ago, another one today, I'd say it's highly likely we're going to break out in the coming days. And I still think this could go on to deliver 100% plus gain for this year, assuming the Biden administration is able to go ahead with their campaign promise and federally legalize cannabis. And I also expect the DEA to come out any day now and reschedule cannabis from Schedule 1 to Schedule 3. That should also help pave the way to remove the 280E tax rule. Cannabis companies can't claim expenses as tax deductions. It's a huge barrier, not to mention them not being able to properly access finance and deal with federal banks, because even though it's legal in more than half the country at the state level, it's still illegal at the federal level. And in addition to Canada, we've also got one of the world's other largest economies, Germany. Going ahead with full legalization, starting on the April 1st, Germans will be able to buy and hold cannabis with the full backing of their government. And so you can use my custom indicators not only just to swing trade. If you wanted to do a mean reversion trade, what you want to look for is a confluence of signals, then play for a bounce back to the mean, this yellow line here, or what you could think of as like a technical fair value. That's the 50-day volume weighted average price, the VWAP. However, this for me is more of an investment, and I just like to buy the dip on the way up and increase my position as it continually goes in my favor. And so for most people, just having one extra profitable trade will cover the lifetime cost to get my 25 custom indicators. That's just a one-time fee of $239, comes with a 7-day money-back guarantee, no ongoing costs, and gets you future access to any indicators I develop free of charge. And this special offer runs out in a couple of days, so if you're interested in taking advantage of that, click the link below this video and head on over to my website, clickcapital.io, and upgrade your trading game today. Stop using all the free basic crap indicators. Most people do. They don't give you an edge nowhere near the same as what my custom indicators I've developed over many years do. And like I said, guys, this is all I do for a living. So you can be sure I'm going to continually making them the best indicators that we can possibly all use together. And just getting back into the daily review, we've got momentum stocks outperforming the S&P by the widest margin since 2008. And just using my sector analysis indicator of the momentum ETF versus S&P 500, over the last year, momentum stocks up 38% versus S&P over 32%. However, that margin has accelerated. Ever since the market bottomed in late October, momentum stocks had been really underperforming for quite some time, and they've just absolutely ripped up, especially from the start of this year when we had an 18 percentage point gap between the rolling 1-year return of S&P and momentum. Now there's a 6% gap in favor of momentum stocks. And there's a look at the momentum factor ETF. You can see it's even in a stronger, more parabolic rise in the S&P 500 itself. Whilst we've still got defensive sectors like utilities pretty much in a sideways trend, even though they had a good day today, up 2.79%. And so the point is, this is definitely a risk-on, growth sector-led bull market with one of the hottest sectors being artificial intelligence. That being reinforced today on news, Amazon investing $2.75 billion on an AI startup, Anthropic, in its largest venture investment yet. And so all the big guys are rushing to get into AI. We've seen that with Apple partnering with Google, and now Amazon, who also doesn't really have a real popular consumer-facing AI product, partnering with Anthropic, San Francisco-based startup that's widely viewed as a frontrunner in generative AI. Its foundation model and chatbot Claude compete with OpenAI and ChatGPT. And so with Google's Gemini going to be on Apple iPhones, Microsoft-backed GPT, now we've got Amazon with Anthropic. Large language models, LLMs, chatbots, are kind of at the center of this AI craze. And that's why they need these big, powerful GPUs that NVIDIA makes to help power them. And you know there's a lot of hype, buzz, if not froth and straight out bubble when you're seeing companies like Oral-B try and sell you a $220 toothbrush because it's powered by AI. That is, the motion sensors recognize your brushing style, guiding you to your best results every time. Sounds pretty great, doesn't it? But they could have just mentioned that as another feature. No one would look twice. However, it's got the word AI, and that's why it comes with the rich price tag, even though you know they made it in China for probably less than $1. And just when you thought it couldn't get more crazy, you can now drink Coca-Cola's latest mystery flavor, created by, you guessed it, AI. This is a futuristic flavored 0-calorie cola, limited edition, named Y3000, co-created with artificial intelligence. Must taste great. However, looking at that thing, it's probably also good for washing your socks in it. So the AI-led bull market's been going on for over a year now. It's spilled over into broader growth sectors, momentum shares ripping up. Now we're getting to the pointy end of risk sediment, and that is meme stocks, with none other than the former president of the United States, Donald J. Trump, jumping on board the meme train and having a bit of success early, straight out the gate, as his new stock trades on the market for its second day, adding another $1.4 billion of market value, sending his wealth to an all-time high, leaving his critics in disbelief. And as no surprise, mainstream media coming out with a lot of hit pieces as well, saying his stock is only going to head lower in the long term, and other negative pieces like have investors read the fine print. The prospectus reads like a police blotter, and this one's a classic by Fortune. The stock price could fall by 95%, says an IPO expert. And who would have guessed it? CNN jumping on board as well. Trump's Truth Social is now a public company. Experts warn its multi-billion-dollar valuation defies logic. Have they checked the other half of the stock market? That defies logic as well, with them also claiming DJT stock creates a unique new ethical nightmare. And I'm not trying to get political here, guys. I always try and report things neutrally, just present the facts and let you guys decide what to make of it all. And politics does intertwine with markets, and we're just approaching months out from the US presidential election, which will have a big impact across financial markets, sectors, volatility, you name it. So of course we're going to keep an eye on it, and this is a big part of it, DJT. And no doubt the business doesn't make a lot of money, and so it's easy to understand how it's upsetting his critics, why it's trading so much. However, they don't really understand the stock market these days. It doesn't really trade on logic or valuation. In fact, profitable companies are kind of at a disadvantage in this market. It's like their business dreams have already been realized and they've been marked down on that. We can see that on profitable Russell 3000 companies trading around 10 times earnings. And it's not just DJT. We've got other unprofitable companies, another social media stock, Reddit, in a classic cash out case from insiders. It too's popped up and is almost traded at double its IPO price. Not to mention anything to do with AI, and even unprofitable donut stocks can get a good pop in this market. So just like Reddit, my point is it doesn't really matter on the business results. If millions of investors pile into this thing, they could easily squeeze it up above $100 a share, just like they can do the same with Reddit. There's no telling how high it could go. Not to mention in the crypto space, companies like MicroStrategy came within a tick of $2,000 a share today. And even though its underlying business has been flatlining, doesn't even do $500 million a year in sales. It's trading on a market cap of $32 billion because it owns 1% of all Bitcoin, but even accounting for the Bitcoin performance, it's become completely disattached from it. And so if Trump really wanted to ride the meme train, he should come out with news that Truth Social is getting into artificial intelligence and Bitcoin, and it would probably gap up to $100 the next day just based on that. That's the type of market we're in right now. So trying to compare these stocks against logic or valuation, it's kind of a moot point. And for sure, either way, this along with Reddit and the others are going to be highly volatile for a long time to come, up and down. Meme stocks have become so popular, we're getting articles now showing you criteria to use to identify them. The first being a quasi-religious fervor. A key element that fueled the original meme stock rally was an us versus them mentality that was fermented on social media. With this strategist going on to say, I've always believed that the company's most devoted investors viewed it as a call option on the MAGA movement. Criteria number 2, a disregard for fundamentals. Like I said before, profitable stocks have been punished. Those that are not profitable, they still have that dream of getting big and the nice story and what it could become. Investors love that. And like some hedge fund managers like David Einhorn and others have said, this market's kind of broken because investors are not doing detailed calculation on the discounted future cash flows of their favorite stocks. Warren Buffett recently said the same thing. Stock market's turned into a casino, and it always has been a little bit, but he said he's never seen more of a gambling casino-like mentality in the market than what he sees out there today. And the third criteria, high short interest. Just like we saw back in GameStop, who had a lot of hedge funds short, like Seidel-backed Melvin Capital, who actually got taken into the cleaners thanks to all the meme traders over on Wall Street Bets. And because they're doing traditional financial analysis, we all know these stocks have ridiculous valuations. That doesn't mean you can short it, because the thing with shorting, you can only make 100%. Stock can't go below zero. However, you can lose 100, 200, 300%, not to mention getting margin called and having to liquidate other positions. That's why shorting, even ridiculous valuation stocks, is so hard, on top of the cost to borrow, which is normally really high on these really hot, low float stocks as well. And that's why they can just go into the stratosphere before they eventually pop. And so I have this chart hanging in my trading office, the tulip price mania back in the 1600s in Amsterdam, and watched financial market historians call first ever bubble in human history ever. There may have been some before that, however this is the one that was the most documented, and this was people going crazy for tulip bulbs. That's the plant, and that might sound ridiculous to us now. However, I'm sure there's some things today people in the future might think we're ridiculous for trying to accumulate, but at least tulips are pretty nice and you can hold it in your hand. Anyway, we can see the price of tulips went about 30-fold start to finish in about 3 years. However, what's different today is that we've all got smartphones and anyone around the world can pretty much buy anything at the click of a button. So maybe back then, if they all had that same technology, maybe it would have gone higher and for longer just because of sheer participation. However, just like in history and all bubbles, they all eventually come back down to reality. It's just near impossible to say when the exact top is, because you could say back here in 1636, prices are ridiculous, the valuations don't make sense, I want to short it. However, anyone who could have shorted it would have got taken out on that final run. So even as a financial observer and independent amateur journalist, it's entertaining to watch and talk about. I myself don't buy any meme stocks. My analysis and investing is still rooted deeply in strong principles that I was taught from formal education when I first got into trading and investing over 20 years ago. And so I still do look at valuation. I think it'll eventually make a comeback like it always does. And one area that looks good to me, and something I've been talking about for a while, is that of small caps, who I happen to agree with Tom Lee here, who has small caps as his number one pick for this year. He still thinks they could go on to deliver 50% gains based on projected earnings, valuations, and revenue growth set to outshine large caps next year. And the setup in small caps fundamentally and technically looks really good here. Like I just showed you on the monthly chart, it's really constructive, breaking out of a big long base. Valuations are cheap, and even though we're getting some signs of unemployment rising, if that were to accelerate into a recession, small caps actually outperform large caps when unemployment rises. And it's not just small caps either, micro caps got a similar look, still well off their all-time highs, and seems to be breaking out of this big base. Could be going into a stage 2 advance, and that's the best place to make money when it comes to any market. And just looking at my top 10 ETF picks I gave out on this channel at the start of this year. The first one was micro caps. The next was small cap value under the ticker FYT. Chinese small caps, which out of all 10 picks has been the worst performing this year, down 6.2%. A defensive pick in global dividend stocks. The second best performing pick, cybersecurity stocks, 3D printing, junior gold miners, agricultural stocks, uranium nuclear energy, and my number one pick, MSOS. And tomorrow's the last trading day of the first quarter this year. And so far as a portfolio, my top 10 picks not doing too bad, up 5.6%, not including dividends that have been paid. And so like I said at the start of the year, I'm going to stick to these top 10 picks and see how they perform at the end of the year. But if I had to change one thing, I would probably add clean energy ETF in there, as I think they're really cheap as well. And we may be in the process of putting in a long-term bottom, coming to the end of a stage 4 decline, if not already started a stage 1 accumulation phase. And we saw that in the clean energy ETF today. Last week we got that big thrust up off the low on volume, traded really well here today, 5.3%. And just going through the rest of the clean energy ETFs, they all look to be holding their lows, if not pushing up off the lows. And just looking at a long-term monthly chart, I think it's still fair to say we could be completing a stage 4 decline. We're coming back down to actually at the lows from COVID, March 2020. And it's been beaten down by high interest rates, people pulling back on those big ticket purchases that clean energy are. Also, the risk in this sector is if Trump does get back in, he's not big on clean energy, so that could be another headwind for this sector. So it still could be some time before we put in a base, before eventually breaking out for stage 2 advance. However, I think that's inevitable as well, because the world is switching over to clean energy from fossil fuels. There's already more investment in this sector than fossil fuels, and the cost of clean energy is coming down every year and better competing with traditional forms of energy that we dig out of the ground as well. So that's more of a long-term investment, clean energy, and it's likely to remain volatile for some time. However, not everyone's on board this bull market. Still got some saying this bizarrely overvalued stock market is poised for a big correction and smart money is moving into cash. Well, there's definitely some truth to that. We are seeing a lot of big insiders cashing in shares over recent weeks, some of the biggest out there. And we've got Paul Dietrich, Chief Investment Strategist of B. Riley Wealth, saying every single indicator seems to tell us we're in a historic bubble. It's hard to look at that and say that we're not going to see a major correction coming. Now is not the time to be putting new money in the market. And that's something I've been talking about every day on this channel for a couple of months now. We had a huge jaws gap between corporate insiders selling here in the red and buying in the blue. Closed in a little. However, that might just mean they've done all their selling. Anyone who wanted to sell has had a chance to sell. Not to mention we've had a changing of the guard in the stock market in the last couple of months. Previous dominant hot stocks, Tesla and Apple, fallen by the wayside in technical downtrends, and with some saying it's still got further to go. Like this piece here saying Tesla could fall another 33% because it's still expensive. That's research house Bernstein cutting its stock price target on Tesla to 120, down from 150, saying it's trading too expensive relative to automaker peers, and also has minimal upside catalysts in sight. Well, no doubt it's expensive relative to automaker peers. However, it's different from automaker peers. They're about 5-7 years ahead in terms of EVs, productions, margins. They've got one of the world's strongest brands, definitely the strongest in the auto space. Not to mention, they're already licensing out their EV charging station networks. The whole industry is pretty much going to run on Tesla. No doubt they'll do the same with full self-driving, FSD. They've also got Cybertruck and other catalysts of Tesla Optimus. That's their robot, which some say could be the next bull market. We even heard NVDA CEO Jensen Huang say the same. And so my point is, yeah, just looking at Tesla's current revenues, they are definitely expensive relative to other automakers. However, they have a more promising future and a head start on all these things, and who knows, maybe in 5 years or so, some of us will have these guys in our kitchen making us a peanut butter and jelly sandwich. Could be possible. However, for now, the stock is still under pressure, still on a downtrend, doing its best to try and find support here. But like I've been showing on a monthly chart, this head and shoulders formation could still play out. We could still see $100 a share this year, and maybe we find support down there as well. One thing's for sure, it's likely to remain highly volatile, and even though Elon Musk, controversial figure, he'll always have his critics. Over time, he's proven the critics wrong. Short sellers lost a record amount of money in the whole TSLA phase, and let's not forget, he's smarter and works harder than all of us, so he shouldn't be doubted whether he can pull off his ambitions or not. And for as long as I've been following Elon Musk and Tesla, almost 20 years now, the critics have always come at him, and they always will. In my opinion, it just emboldens him further. And I remember this one from February 2015, another classic piece from CNN again. Elon Musk's insane call. Tesla worth $700 billion. Tesla CEO Elon Musk says a lot of bold things, but he may have just outdone himself. He thinks the stock will go into insane mode over the next decade, telling investors Tesla could be worth $700 billion by 2025. Well, not only was he right by 5 years. Tesla actually passed that valuation in 2020 and actually hit $1 trillion. And if you're looking at his latest prediction, he said Tesla could be worth more than Apple and Saudi Aramco combined by 2030. That implies a market cap over $4 trillion. So again, my point is, love him or hate him, you don't have to like his personality. Just be careful in doubting his work and output, because he is constantly proven the critics wrong and wrong time and time again. Just moving on today to commodities. We got crude and gas inventories come in a bit higher than expected, causing crude just to pull back a little bit, but it's staying pretty well bid, with I'd say geopolitical tensions having a lot to do with that. We just heard from JP Morgan today saying Russian action may bring $100 oil on the back of the decision by Moscow to cut oil production. They could potentially take oil to $100 a barrel this year. They're the second largest producer in the world after the States. They do have big influence on the crude oil market. And there's a look at crude there. It's kind of in a slight short-term uptrend, but energy stocks doing a lot better. We can see that in XLE. Kind of moved into a parabolic uptrend here. My trend strength going really positive, really high, really fast, indicating this could last for some time, even though we'll probably get a short-term pullback soon. We've also got Bitcoin taking a bit of a breather as we go into the halving. Happens every 4 years, in which the supply of new Bitcoins being mined each day gets cut in half, as it's designed to be an anti-inflationary asset. And that's why a lot of wealthy people have tried to corner it for themselves, because it's kind of impossible for the world to grow without a little bit of inflation in its money supply. Just obviously too much inflation in money supplies are bad. And the SEC is not fully on board with it, even though Gary Gensler was kind of forced into approving these Bitcoin ETFs. They're still coming after Coinbase, and recently just scored a big win. Judge ruling that the SEC's claim that the cryptocurrency exchange engaged in unregistered sales of securities could be heard by a jury at trial. And so the whole industry doesn't know what crypto is. SEC is trying to accuse it of being a security, in which it would then come under their jurisdiction and rules. Others say it's a currency, even though no one uses it as a currency. And Coinbase themselves actually tell the judge that buying crypto is like collecting Beanie Babies, which is a popular toy from the 1990s. But the market's not too upset for it. Coinbase only down 3.79% today, still holding an uptrend here. And the underlying Beanie Baby itself, Bitcoin, still just trading below $70,000 a coin. And I thought I'd just show you guys something interesting today, and that's Bill Ackman's hedge fund returns, which I just got a hold of for his company Pershing Square Holdings. And I thought it'd be interesting to show you guys what one of the best hedge fund managers of all time and his returns look like. Because a lot of people have unrealistic expectations when it comes to trading and investing. And so Ackman has been running a hedge fund for 20 years now, and he has significantly outperformed the S&P 500 with both of his funds. His best one up over 2,000% in that time. And even though the S&P 500 has had record returns for that rolling 20-year period as well, it's up 592%. And what's interesting, just looking at his year-to-year returns, is that out of the last 20 years, he actually underperformed the S&P 500 in 10 of those years. And his compounded annual return coming at 15.6% versus S&P at 10%. So the point is, to beat the market in the long term, you don't have to beat it every year. You don't have to swing for the fences, risk your whole account. And even though that annual outperformance doesn't look like much, just 5.6%, we can see over the long term, just outperforming by a couple of percent per year can lead to really big outperformance. But one thing you notice in his returns is when he loses, he doesn't lose too much. In fact, in both of his funds, the worst year was 2015, down 20%. However, when he wins big. 2020, he nailed it, up 70%. And Bill Ackman, like a lot of good fund managers, has always run a concentrated portfolio. Currently only has 7 different stocks in there. Normally he has between 5 and 8. And there's a look at his latest portfolio. Largest holding, Chipotle, Restaurant Brands, Hilton, Howard Hughes, Alphabet, Canadian Pacific, and Lowe's. So pretty simple, obvious businesses. He just buys them at a good valuation. He was more of an activist in previous years. He still is, but just less publicly so, and has a strong tilt towards simple, understandable businesses like restaurants. And he just recently launched a fund for everyday investors in the US for a new closed-end fund, Pershing Square USA. If approved, it'll trade on the New York Stock Exchange under ticker PSUS. I just checked, and it doesn't appear to be trading just yet, but I'll keep you guys updated for when it is. Just moving on to economic data we got out today. Not much from the States. There's just the oil and gas stocks coming in higher than expected. Tomorrow we'll get GDP data, consumer sentiment, and this is a shortened trading week. US exchanges shut on Friday in observance of Good Friday. It could be interesting because we're still going to be getting PCE data and hearing from Fed Chair Powell as well, which if we get any surprises is going to make for an interesting Monday morning of trading. And the market's still given 70% chance he's going to start cutting rates in June, with the greed index still holding firm at 70. And we've pretty much covered all the charts today, guys. Like I said, this is going to be a quiet, low volatility, low volume trading week as we go into the long weekend. So I'm expecting more of the same tomorrow. And overall, the market is still very much in a risk-on, bullish growth mode that's likely to persist for some time, with the biggest risks being higher than expected inflation data or external shock and surprise from somewhere else. That's all for today. Thanks very much for tuning in. And just as a reminder, my Easter special runs out in a couple of days. So click the link below this video and check that out if you're interested. Thanks very much. See you again tomorrow night. Cheers.